So good morning everybody and welcome to yet another episode of Centricity Speaks. Today we are here to discuss a very interesting topic. Is equity the answer to all wealth management needs? So we have today with us Mr. Aditya Shankar and we have Mr. Anirudh.
Hi Faraz. Hello viewers.
So welcome both of you, and as I said, we are here to discuss about this very interesting concept or a statement what generally people make. Is equity the answer to all wealth management needs? So I'll tell you the genesis of this particular topic. Is I have been meeting a lot of partners in the last few months, and the obvious questions, question that I have been asked is that if equity is giving 10-year, if you look at the returns of equity on a 10-year horizon, it is supposed to be the best asset class, which is giving the highest level of return. And in 10-year period, the possibility of negative returns is almost mitigated. So generally, in innocence, I would say these partners, they ask this question that why should I look at any other asset class? So from their perspective, they believe that it is the only asset class to look at. So I would request for your views on this particular subject.
First of all, thank you so much for the introduction. And this indeed is a very, very interesting question, and which has been asked not only by partners but a lot of very well-heeled investors who have been in the market for a very long time period. So, although the question appears to be what you just said, is equity an answer to all wealth management need? But what one is really asking is that does asset allocation as a concept make sense?
Yes, exactly.
That is the underlying question. Right?
Yeah.
So if you look at it, equity as an asset class will always invariably outperform any other asset class if you look at a longish time period, 10, 20, 25 years. That has been the case in most developed markets. That has been the case in India. And except for a very few exceptional economies like Japan, etc., this will continue to be true for more, for the rest of the world also. But if that is the question, why do other asset classes exist in the first place? And why is there a tendency to diversify one's portfolio across different asset classes? Although you might be aware of the fact that the other asset classes will always be a slightly lower return asset class as compared to equity.
Yeah.
So that is the underlying question. If I may elaborate on this, over a 20-year time period, if you look at it, the Nifty and Sensex have grown many folds. We have seen Nifty growing from, even if we take a very relatively shorter time period from 2016 to 23, we have seen Nifty moving from 8,000 to 18,000 and so forth and so on. So if that is the case, one should really put all our eggs in one basket, which is equity, and not look at any other asset class at all.
The logical answer is no, yes. But please elaborate.
Yeah. So my counterintuitive point here would be, if you look at very select time periods, right? If you look at time periods such as from 2000 to 2004, so 2000, as you might remember, and not many of our partners remember, was the dot-com bust, right? And this was a worldwide phenomena.
Y2K.
Yes, the Y2K. Quintessentially, the IT story kind of came to a halt, grinding halt. Eventually, it took, the premise was proven right, but for a 3 to 4 year time period, equity market did not perform at all, right?
So, just for the benefit of viewers, let me tell you that there was when this whole issue of Y2K actually unfolded, for a period of almost 4 years, the equity market did not give any return. And in fact, people, without understanding the risk involved in sectoral funds, they invested heavily in technology funds at that point of time, and they crashed. So there was a flurry of IPOs, because NFOs were known as IPOs at that point of time. So there was a flurry of IPOs, and everybody left, right and center who ever had any idea of mutual funds, they invested heavily into the IT sector funds. And then subsequently, when the Y2K bust actually happened, the experience was very, very different.
So the dot-com and the tech was actually the flavor of the season. And
Exactly.
we have seen that happening multiple times, multiple cycles, not just 2000 to 2004, but even 92 to 99. The markets had given a very flat return of almost 1.5% CAGR. And similar thing has happened in 2008 to 2014 as well, where your CAGR return is only 2.5 while your inflation is in the band of 4 to 5%.
So again, a recap, 2008, the Lehman crisis, the subprime crisis actually happened, because of which there was a very elongated period wherein the equity markets didn't perform across the globe and in India. India was no exception.
So, corrections, as we would know, corrections may not only be absolute corrections, but also sideways correction. For example, if, as an asset class, the indices don't move, or stocks in general don't move over a period of say 2 to 3 years, there is always an opportunity loss of having earned a basic return in any other asset class. So that is also a correction. So we saw a similar correction somewhere between 2016 to 18. And we have also seen recently post-COVID, such a phenomena where, immediately post-COVID, the markets ran up very, very sharply. And then for a 2-year time period, almost from 2021 to almost about a month ago, markets were relatively flat, no returns at all. So these have been periods where if somebody was invested, it would really test his or her patience in terms of not generating any returns. And in that time period, the importance of asset allocation actually comes to the forefront, where one realizes that had he put some eggs in other baskets also, which performed relatively better during these downturns in equity markets, it would have been better for him.
Why I'm smiling? Because I'm remembering a classic question which is thrown to asset advisors in this period is, इससे अच्छा तो FD में लगा लिया होता. So what can we do to avoid this question coming up? इससे अच्छा तो FD में लगा लिया होता. So Anirudh, if you can just throw some light on it.
So Farhad, we need to take a step back. I understand that this question always comes to us that equity is doing so well. Why anything else? But what we need to also understand is that not every investor is same. Not every investor's risk appetite and investment horizon is same, right? Not everybody can be invested for the entire amount for 10 years plus. There could be a requirement or need, unplanned needs. There could be exigencies, family emergencies. There could be opportunities as well, right? For which you might want to take money out of your portfolio and invest or use it for those particular requirements. Now, if you are in equity, right? And over a 10-year period, of course, equities, we have seen that 10-year rolling returns have been fantastic, and it is always positive. The probability of losing money is almost zero, actually zero. Greater than 5 years, it actually becomes zero. And in that scenario, if you are stuck in a period where, say for example, September 2007 to September 2022, most of the markets have given phenomenal return for the 15-year period, but Shanghai Composite was actually negative, even in a 15-year period. Now consider you are invested in a market and you are actually negative. Now, at that point of time, you can't really pull out money from equity and use it for other purposes.
So again, I would like to bring a point over here that financial planning is very, very important. And in financial planning, there is a life stage planning which one has to do, which is very, very important. And that is where asset allocation comes. So Aditya, we have had a discussion. So just to elaborate the whole asset allocation process, and how to actually guide this thing. One should actually kind of sail through this whole process.
So before that, I would just like to make one point. So financial planning is a sister concept to asset allocation, as in you ultimately arrive at asset allocation after doing a thorough financial planning, which is essentially understanding the risk profile of the customer, the age profile of the customer, what is the tenure, or what is the time period that one is willing to give to his or her portfolio, and what is the ability of the customer to take risk, which falls into the ambit of the risk profile only. After you do all of this, you ultimately arrive at an asset allocation for an investor. It also depends on which stage of vesting the investor is in. So if one has already completed the vesting stage, if one is already sitting in a corpus, goal planning may not be that much relevant to him, then you have to just simply allocate assets, allocate the portfolio to different assets, and just basically look at earning a desired rate of return which the investor has mandated.
So just to elaborate this point, what Aditya has made is, suppose if somebody has started his career, or there is a wealth accumulation phase wherein people are creating wealth and people are creating a corpus. And then there is a wealth preservation stage, which is the ultimate stage wherein people have generated a corpus which suits their demand. But now the whole preference or the whole impetus is on how to generate best risk-adjusted, inflation-adjusted returns.
if one is in a very initial stage of accumulating the corpus, one has just started a career or just started a business, he might definitely want to go very aggressive on equity because he is in the process of a very long-term financial planning. But let's say somebody is retired or somebody has exited a business and has come into a lot of liquidity. One's goal would be typically that I've already made my money through equity in my business. Now I'm just looking to beat inflation at a certain.
This is a very interesting point which you have made, Aditya, that as far as businessmen are concerned, they are already invested in equity of their own company. So it's not that their equity allocation is zero. In fact, their equity allocation is very high, and hence a need to balance.
Yes.
And now I actually am able to relate why, especially HNIs and ultra HNIs, they actually prefer more of debt, because they are actually running a very high risk when it comes to equity assets, which is in this case their own equity of their own company.
Now, to simplify this further or drilling it down further, for us we also need to understand what are the asset classes that we are really talking about here, right? So real estate, we all understand, especially in Indian market, Indian context, all of us understand real estate. That's one asset class. But in terms of financial asset classes, there's equity, there's debt, which is fixed income, there's gold, and there's cash as well, right? Typically, we consider these four as the asset allocation, asset classes for further allocation. And there have been times when equity has been negative for, multiple years or in that particular year, but the gold has given positive returns. Debt has been in the band of 6 to 8% on an average, typically in the short term. Now, there also, there's a cycle which plays out. We call it market cycle. If the inflation is going up, you try and play the short end of the, or short medium term funds that you try to play. If the inflation is going down, you try and play the tenure and the duration. You try and play the duration. And then there are times when there's hardly any spreads left and you have, credit opportunities to up your yields, right? And then you try and play the credit in the portfolio depending on what your risk appetite is. And there have been times when gold has given phenomenal returns. We have seen it in the past.
We are seeing it now, in fact.
Absolutely. So, suppose you consider 2003 to 2018 as a period, right? The gold has given almost 14.5 to 15% annualized return, average return. Equity has given 20% annualized return. Debt has been in the band of 6 to 8%. And cash has been in the band of 3%.
So when we are talking about debt, I guess this is a very conservative debt. We are talking about short-term debt.
We are talking about short-term debt because we are essentially talking about the bare minimum return that debt as an asset class will give. So we can obviously take certain aggressive, very specific calls depending on the cycle of
credit play or duration play.
Like Adut mentioned that if it's we can lock in yields through credit play when interest yields are at all-time high. And when yields are expected to come down, as was the case in March of 2023, we would want to play duration also, or basically take a bet on interest rates falling in the near term, which will benefit the investment. So these are specific calls, but what we're talking about is the bare minimum return that a debt essentially will give in a short-term instrument.
Now, I'll like to play a devil's advocate over here, and I'll like to throw certain questions which are often put across to our community. Is one, right now the markets are at record highs. So what should one do? There is one set of people who follow the herd mentality, and everybody, without thinking much, they're putting a lot of allocation into equity right now, and they weren't some time back. One set of people are those, and one set of people are those who say markets are at a high, there is greed coming in the market, so one should stay away from it. So at multiple stages, I've heard these questions. So when the market touched 10,000, then also people asked this question. It was a lifetime high, and in fact we have been making lifetime highs in the last 2 decades, 10, 20, 30, 40, 50, 60 and now 65. So we have been making lifetime highs. So how should we rudder in this times?
So the first very intuitive answer is that what we have been discussing all along in this episode, which is asset allocation. At all points of time, continue to maintain asset allocation and rebalance periodically. Which is that if your asset allocation brackets have been breached, the limits have been breached, book profits and move into the other asset class to maintain the same asset allocation all throughout. One is that irrespective of market, because nobody can be expected to play a soothsayer. Nobody is expected to know what is going to happen. Otherwise, everybody would be a billionaire today. So to maintain, a very, very focused approach towards asset allocation, one, that is the way to play it, not equity, but investment portfolio. Second is that, if you really look at equity, let's talk about only equity. There is no such thing as markets are at all-time high, right? There is no such thing as that, because I've been hearing this for the last 20 years.
Yeah, it is just an absolute number.
It's just an absolute number. And if you really ask me, and you can add the finer numbers, that at 10,000 Nifty, the Nifty was relatively expensive as compared to 19,000 Nifty, right? So PE wise, basically.
Yes.
So there is no such thing as 19,000 is more expensive than 10,000, because if you really look at the the expense that one has to pay to earn that return, it is cheaper today than it was to play the market at 10,000 Nifty.
I'd like to take a pause over here. For the benefit of the audience, I would like to tell what PE is. PE is basically a concept wherein what is the price one is willing to pay to earn 1 rupee from a company. So, if example, the price of a particular stock is say 100 rupees and the EPS of that particular stock is 10 rupees.
Yes.
So, what is that you are willing to pay? So, in this case, 100 divided by 10, it will be 10 times. So, if there is another stock which is again at 100 and it is giving a EPS of say 20 rupees, that is at 5 times. So superficially, the stock which is at 5 times is cheaper and the stock which is at 10 times is costlier. So continue please.
Just to add Nitya's point, there's one more phenomena, we call it recency bias, which plays a lot in the psyche and the emotional behavior of an investor. What happens is, when we have seen recently that markets are going up, there's a tendency for us to throw the caution to the wind, right, and actually start behaving in a way that
I totally agree with you, Anuruddh. So just don't go too long, just go a quarter back or 6 months back. Everybody was pessimistic about equity, and right now recency, again, we have had a wonderful run in the last 1 month, and now everybody is wanting to invest into equity.
any newspaper, any blog, any article, everything now talks positive, while 6 months back everything talked negative. And sometimes it is also about greed versus fear, which Warren and very much.
So Aditya,
These fear factors have still gone away, as in the fear factors that were being played out in the media, ranging from the Ukraine war to the financial crisis, through an impending political crisis in the US. God knows what all was being played out to portray a negative aspect in the market. All of those factors still remain while the markets continue to rally. So the recency bias, of course, is the point. Now, I think
so coming back to the point which we were talking about, PE and the earnings. So that is something which is of prime importance today. So Aditya, please elaborate on it, and how PE and the earnings, they actually actually are the yardstick of the equity markets.
I think from a long-term indicative perspective, PE is the most important yardstick to assess if equity markets are going to perform. Other than many other factors like liquidity, etc., exuberance, global exuberance, local exuberance, etc. But earnings essentially are a mirror to a better performing or a worse performing equity index, which is that every company which is listed has an earning potential. If I was to standalone invest in a company, I would say that I have to spend 100 rupees to earn 1 rupee, right? Or do I have to spend 1,000 rupees to earn 1 rupee? So technically, the company where I have to spend only 100 rupees is a better investment avenue if the future projections are brighter. So that is a yardstick. Now, if I combine all these companies which are present in the index, I arrive at the PE of the index.
So weighted average PE.
Weighted average, right? So again, I'll have to see whether as a weighted average, the expense to earn 1 rupee is justifiable at this point of time or not. And again, I come back to the point that it is cheaper now to invest in the Nifty than it was at 10,000 level. which means that there is no such thing as 19,000 being more expensive as 10,000. It's just an absolute number.
So I think so. There's one more thing. There's something known as a forward PE also, and that is what actually is the main number to look at, because there is guidance. So just to give an example, so when somebody started a career, he was earning 10,000 rupees. So that was a peak for him. Now the same person after 20 years might be earning 2 lakh rupees. So same is the case with the Indian market, the underlying of the Sensex or Nifty, that 20 years back, they were earning a particular amount as a basket. Now it has gone up several times. So from an absolute perspective, we were at 5,000 or 3,000 20 years back, but now we are at 65,000. But look at what these bunch of companies is giving you or is earning for you. That is important, and that is what dictates where the markets are going to go. And again, it is India is becoming a dominant force day by day, and it is being said that the Indian economy is going to double its GDP in the next decade or so. So if this happens, the earnings also go up, and what will happen to the indices, I think so it is very much understood.
Yes.
So again, sir,
I think the final question that we should discuss is if we have arrived at a consensus, and if everybody agrees to the fact that there is something called asset allocation which is meritorious, then how to go about it? How should one go about it, and what are the parameters that one should consider to be in a certain asset allocation? So I think Anirudh can throw more light.
Yes. So while doing asset allocation, there are various parameters that one should keep in mind. One, what life cycle the person is, right? What is the age? The thumb rule is that 100 minus age should be your equity allocation. That has been a very old thumb rule, right? So if I'm a 30-year-old, right, typically my tendency to put in equity will be about 70%.
so this is again rule of thumb. If somebody is aggressive, they can go more than that number. If somebody is conservative, they can be lesser than this number.
And it also depends on, which life stage cycle I am in, right? Whether I'm in the accumulation stage, where I'm in the consumption stage, or I'm retired and completely dependent on what I have accumulated so far. And therefore, my risk appetite and asset allocation will be very different in person. So ultimately, it depends on what are the milestones ahead of you. Whether it is, if you have children, their education, their marriage, right, sending them abroad. There could be a foreign trip on cards, or you want to purchase a house or a, car. So all these could be various milestones in your life, and therefore you need to decide how much you should accumulate and how you should allocate across various asset classes. Another factor which is very important is the market cycle, which we discussed last time as well, right? If you are in a growing increasing inflation scenario or a growing economic scenario, how you should play equity, debt, gold, etc. So all these put together, which your financial advisor and MFD can help in arriving at a asset allocation number. And discipline is the key. The long-term investment and discipline is the key to have a less volatile and a peaceful sleep.
So thank you, Aditya, and thank you, Anirudh, for this lovely all the lovely insights. And just to conclude, what I would like to say is, one, equity is one of the best asset classes for long-term wealth creation, but it is not the only asset class. Your life stage will dictate which asset baskets you should be investing into. Point number two, the classic question of whether I should invest now in the equity markets. Don't look at absolute numbers of the indices. Look at how cheap or how costly they are. So that is governed by PE, one of the concepts we actually told you, and the forward PE, and the future prospects of a particular economy. So fortunately, we are in India, and we are all Indians, and we are proud to be Indians. So India is growing, and it is becoming one of the major economies and financial giants in the world. So one needs to capture the growth, but with prudence, and prudence is going to be asset allocation. So thank you so much for giving time, and please do subscribe to our channel. Thank you so much.
Thank you, sir.